Hi, everyone. I hope this finds you well. It continues to be a bit of a wild first half of the year. I'm sure that many of you are just as frustrated as I am with the headlines and the market volatility we are seeing, especially in the last few weeks. The last time we talked about the markets in February, I said that it was going to be a return to normal. And believe it or not, I am still optimistic that that will be the case this year. For all the negative headlines out there are still, I would argue, some bright spots. That being said, as of this recording, the S&P 500 has fallen by nearly 20%, and depending upon what happens over the next few days, it may mean we are in a bear market. Almost all of you have been investing for some time, and intellectually, we know these things happen. Over my 25-year career, I have witnessed or helped clients navigate through 4 bear markets, roughly one every 6 years. Each of them have had different catalysts: the tech bubble followed by 9/11, the Great Recession, COVID, and if this market does continue into bear territory, we will most likely point to inflation as the catalyst. In addition, we've had 3 occasions since 2010 when the market fell by 18 to 19% before rebounding. In each of these instances, patience was rewarded. As a matter of fact, as this chart shows, each time there has been a pullback in the first quarter, as we've seen this year, the second half of the year has been positive in all but one occurrence going back to the Great Depression. One of the questions I've been getting more often than not lately is it different this time? And to be honest with you, no, I don't believe that things are different. We've seen markets with high inflation before, and there are tried and true strategies for navigating through these kinds of markets. As an example, dividend-paying companies, manufacturing companies, and healthcare companies all tend to do better over time in inflationary cycles. So why am I optimistic? First, while the Federal Reserve has told us that they will be aggressive in raising rates to fight inflation, they have been measured and predictable in their approach. Talking heads may complain about the pace of the policy being implemented, but the markets want some predictability, especially with the geopolitical risks out there. Second, there is still pent-up economic activity that has been delayed by supply chains. And while I don't expect that to get resolved this summer or even this year, there has been progress. There are so many people traveling for the summer despite higher costs for gas and airfare. Airports, hotels, and restaurants are full. And I expect people to increase spending on experiences and family gatherings this year. As an example, we've seen an increase in weddings this year. The running estimates I see say there are 2.6 million weddings this year, 400,000 more than we had in 2019. Third, unemployment continues to be very low. Of all the factors, this one could turn around somewhat quickly, but every business owner I speak with continues to tell me the same thing. It's hard enough to find people, let alone good people. The bottom line is it's hard to have a recession when unemployment is this low. I recognize that when these downturns happen, they are concerning in the moment. We are all being bombarded by negative news by the media, friends, and in my case, even our plumber. As I said in February, it's really easy to sound smart when you're negative, but looking beyond the headlines and seeing the opportunity on the other side is what makes us smart in the end. 71 out of the last 100 years have been positive for the market. Positivity wins, and so does experience in how to navigate things as they change. Please know that I'm here to walk you through what we see both in the short term and in the long term. Thank you all very much for listening. Have a great day.